Episode of the Financial Frontier. I'm your host, Patrick Camuso. There's a lot that I want to cover today on the regulatory front, a lot of news in the headlines regarding tax enforcement and other Web3 aspects of, regulatory actions in Web3 that I want to go over today. So, a lot to cover here. I'm very excited for today's episode. I want to get right into it, and I want to start by sharing my screen. Um, Give me 1 second here. And for the podcast viewers, this is also a video broadcast, so I do share my screen, but I will explain everything that I'm sharing if you don't have a video viewpoint. So let me just make sure this is going good. So firstly, I want to announce the release of my book, and I also have a copy here. It's called Navigating the Sales Tax Maze, Wayfair 2.0 for Web 3.0, from virtual assets to real obligations, decoding tax compliance in the digital realm. So this book is going to give you an overview on sales taxes and other indirect taxes and how those taxes can apply to on-chain transactions, with a heavy focus on sales taxes applying to NFTs, because this is something that is going overlooked industry wide. We've seen this book will explain, we've seen many states already give guidance regarding the taxability of NFTs as it relates to indirect taxes. And what I'm seeing is industry wide non-compliance. So, sales taxes and NFTs sort of feel to me like crypto taxes back in 2016. It's this consideration that is going overlooked significantly, and as a result, just creating this huge industry-wide tax risk. So, the reason I wrote this book is because I think we need to be making more people aware of this. And, the first step is with education, and that will hopefully lead to compliance. And, me and my team will be there to assist with that as well, of course. So go to Amazon. You can type in Navigating the NFT Sales Tax Maze. It'll pop right up, and you can get your copy today. So next, I also want to point out we just did a presentation with CryptoWorth. And what we were doing there was going over their platform, a specific feature on their platform that helps to streamline the process of due diligence, specifically your due diligence on the calculated ending cost basis to the actual ending cost basis. The reason I'm really happy with this and was excited to do this was because this is another item where, when I'm trying to onboard a new company or even a new investor into my firm, and they have had prior accounting completed, either self-managed or by another firm, the first thing we need to do is roll over their detailed ending basis into the new tax year that we're going to start. And a lot of times we'll find there's been poor due diligence and sometimes no due diligence done, and sometimes depending on what software they're using, they may not even have the correct reporting for this. So this is another huge issue that I'm constantly addressing with new prospective clients, and it just seems to be, it's a very basic due diligence check, but it's extremely important, and I'm surprised how much it's going overlooked, but it is. And we sort of go over that in this video, and we also go over how CryptoWorth can help streamline this, because they have reporting that will just basically pull in all of this data into one report and do a comparison to the calculated, rather than you having to manually do that process. So next, I want to talk about this article, the Duna and Oasis for DAOs. So recently, Wyoming has just launched a new entity structure, a new legal entity structure that companies can adopt in Wyoming, and this is specifically targeted towards DAOs. So this is the entity structure is going to be called the DUNA, D-U-N-A, and that stands for Decentralized, a Wyoming Decentralized Unincorporated Nonprofit Association. So overall, I think this is a step in the right direction, and Wyoming, has been out ahead a lot on DAOs and on blockchain and crypto in general. So this is good to see. But there needs to be new entity structures that we see these DAOs adopt, because industry wide there's huge issues with a lot of DAOs just not having proper entity structures at all, due to the fact that they want to remain so decentralized. And the issues that come along with that can be fairly large, when we're looking at it from a legal standpoint and also from a tax and accounting standpoint. Having that legal entity structure is going to drive your tax functions, your accounting functions, and also it's going to usually limit the liability of many of the members in the DAOs. And when they're operating without this, all of these functions suffer, and sometimes can be impossible to perform compliantly as well. So this is going to be just this type of entity structure is going to be an unincorporated nonprofit association that just has this decentralized element to it. Here is an overview of it that they included. So the Duna is going to basically act as this, public infrastructure that's in between the blockchain functions, and that's in between the actual end users that would be interacting with the company. And this public infrastructure can allow them to, sign tax returns, conduct business legally, and perform these types of functions. So here it says, DAOs that fail to use legal entity for their organization are deprived of a legal existence, unable to pay taxes, and exposed to potential liability. So that's exactly what I was saying. It's just so much risk right now to be operating a DAO without a proper legal entity structure, and that's why these emerging structures that are trying to be more DAO friendly are important to at least consider. And if you don't take on these structures, you should take on some other form of a legal entity structure. And as it says here, a lack of legal entity structure also threatens the privacy of DAO members. Another interesting thing I wanted to show on this here, I'm just trying to scroll down to it. So here it says, the DUNA can remove complexity as to how DAOs would be treated under tax laws because their ability to be taxed as corporations. And then, it would allow them to pay their tax obligations in a manner that won't require the disclosure of individual members and avoid, the complexity of pass-through taxation that we would see with a partnership structure, which in a lot of cases, if you're not going to organize your DAO appropriately, you may be looked at as a partnership. And then you'll get to enjoy all the tax treaties they're saying here as well that are associated with the U.S. because you'd be, a U.S. corporation. So why haven't DAOs adopted this? So these are some of the reasons that you're going to see objections to industry participants for adopting DAOs and legal entity structures in general. I wanted to touch on this because I think this is where a lot of the friction is. And a lot of times it's just the fact that, we want true DAOs, decentralized, autonomous organizations, with, I guess, the last part being used loosely. But from a regulatory standpoint, everything hinges on some form of centralization. So there has to be some meeting in the middle. So, limited flexibility associated with the nonprofit status. That is one thing, that is one objection that we're seeing raised to this. The undermining decentralization. This, I think, is probably the biggest one. Some have argued that the UNA introduces centralization risk. And, again, to a degree it does, but if you're going to have tax reporting and a legal entity structure, you're going to have some form of centralization. But where the DUNA is offering, some benefit is the fact that like it was saying, it's not going to have every single member having to get reported on the tax return. It would just be some officers that would have to get assigned to this type of structure. Jurisdiction selection. So some have argued that DAOs are not located in any jurisdiction and therefore should not elect to adopt an entity in any jurisdiction, including UNA. So this sort of goes into the decentralized aspect. They are saying because the DUNA has distributed members across the world that they don't have to pick a jurisdiction, but the jurisdiction will basically probably take them to court and pick it for them. In that case, as this is going to explain here at the end, it says DAOs ignored its own risk at your peril. Undermines permissionlessness and unclear use case untested in court. So these are all valid arguments, but if you see, most of them are just going to the fact that many DAOs just don't want to undermine decentralization. They believe that the jurisdictions don't apply to them, and they want to just basically maintain the permissionlessness that is associated with this. So these are going to be, continue to be emerging tax issues. We're going to see new legal entity structures develop around this, and we're going to continue to track this closely. But I do think that, this is interesting and a big deal, and something we're going to continue to track, the fact that Wyoming is creating these legal entity structures. So here we got an article out of Cointelegraph. Biden resurrects the 30% crypto mining tax in the new budget proposal. So U.S. Senator Cynthia Lummis said that while this shows that the government is bullish on crypto, a 30% tax would destroy the industry's foothold in the country, and I don't disagree with that. So this is the excise tax that Biden wants to put on miners. Basically, here the Treasury wrote this: any firm using computer resources, whether owned by the firm or leased by others, to mine digital assets would be subject to an excise tax equal to 30% of the cost of electricity. So they're doing this all basically with the claim that crypto mining is wasting electric and wasting resources. So now they want to apply this excise tax to it. 30% is a large amount. The proposal is supposed to roll this out over 3 phases: 10% in the first year, 20% second year, 30% third year. But that is going to hurt miners significantly. I believe a lot of them maybe would even want to start looking at other options if they're large enough outside of the U.S. So we'll see if this proposal gets accepted, if this gets accepted as part of the proposal. What I will say is, this has been something now that you've probably seen me talk about a few times, because it is something that keeps getting proposed but not passed. And we'll see if that's the case this time, or if they'll be able to push it through. Of course, I'd like to see this tax not get levied on miners, but it is something we're going to have to watch closely and plan for appropriately. So next, Toomey Cinema Eye exempting small crypto purchases from capital gains. So this may be something else you've seen me talk about before that is sort of getting resurrected now in a new attempt at getting this passed in a new bill. So Senators Pat Toomey and Kristen Sinema from Pennsylvania and Arizona introduced legislation that would exempt small crypto purchases from capital gains. So this is basically a de minimis exception where they're trying to have personal transactions that are under the threshold of $50 be exempted from capital gains. Where this would help the industry would be removing some of the accounting and administrative burden, as well as the tax burden, from people that want to use crypto for everyday transactions. You can picture now, if you wanted to use Bitcoin, Ethereum, or some other asset for a micro transaction like this now at a convenience store, you're going to have to be tracking that for tax and accounting purposes. And if you're going to do that for all of your transactions, it's going to create a burden for you as the taxpayer. So this de minimis exception could be great for that purpose. And this is something I've been wanting to see get passed for some time, but this is another one of those proposals that doesn't ever seem to get passed. But, we're seeing another attempt here at it, so we're going to watch this closely as well. So next up here, you're going to see the EU scraps proposed 1K payment limit for self-custody wallets. So the European Union's new AML laws are limiting cash and crypto transactions. But it appears now that the proposed non-custodial wallet limits did not make the final cut. So you may have seen this in the headlines. The EU is going to start to require KYC on certain non-custodial wallets. So in an earlier proposal, we saw businesses limited to €1,000 if using a self-hosted wallet to transact was removed, along with the provision that aimed to implement identity checks on self-hosted wallets. Now, crypto exchanges, which they refer to as crypto asset service providers, must perform customer due diligence and identity verification checks on users who carry out businesses transactions of at least €1,000. So it looks like they removed this for non-custodial wallets, but basically they're still applying it to exchanges. It also says here that they must apply mitigating measures to transfers between their platform and self-custody wallets where users hold private keys, which include at least verifying the identity of exchange wallet holders where funds from a self-custody wallet were sent. So, here what they're doing is basically closing the gap of pseudonymity in wallets, and we're going to start to see more and more requirements from a regulatory perspective that require the KYCing of non-custodial wallets. Now, this may be requirements that we see via the EU. This may start to become a requirement for, sales tax or other indirect tax purposes, or this may be something that we see here in the US as part of the proposed broker regulation. So I think we're seeing from a lot of different perspectives, the goal of regulators is to get a higher level of KYC on these non-custodial wallets. So this is something we're going to be watching here further in the EU and to see how this develops. Next, we have news out of India on the indirect tax based on digital assets. So India seeks info from crypto exchanges as it molds a GST on assets. So India's Central Board of Indirect Taxes and Customs, the CBIC, who's responsible for the formulation and collection of indirect taxes, has asked major cryptocurrency exchanges to provide details on the type of digital coins being traded along with their valuations. So it's just asking for basic information. It wants to know the fees, the types of assets, and what it's exploring is a GST tax, which is a indirect tax. It's sort of like their version of sales taxes. And they, may start levying this on certain types of cryptocurrencies. So we're going to see tax authorities worldwide start to look at how indirect taxes apply to crypto transactions. We're seeing that now with India with GST. We're seeing that here in the States with sales taxes, and we've seen it across many other countries. Most recently, we've also seen it in Canada, along with many others. So this is something else, that I am expecting to pick up, and that Web3 businesses are going to want to watch closely to ensure they, continue to stay in compliance with all of their transactions. So here I wanted to go over briefly a case study of a client that we worked on. So with this client, the biggest issue with them was getting like this happens a lot where, a client will work with us and they've gotten prior year accounting done somewhere else. And, the first thing we have to do is basically, if we're going to start with prior year accounting from someone else, we need to make sure that the prior year accounting was accurate. In this client's case, they, under advisement of their prior firm, made the error of selecting highest in, first out across their whole entire portfolio. And I see this as a common issue. People just want to get the lowest tax rate possible, but they're not thinking from a compliance perspective as well. And, in this person's portfolio, they were not meeting the requirements for specific identification. Mainly, they weren't managing their assets on chain in a way that can facilitate the accurate reporting of specific identification, and that really went for any of their assets. But they were blanketly choosing HIFO across all of their assets. So what we had to do was go back and recalculate their portfolio using the right accounting method, which is FIFO in their case. And then we had to roll their basis forward each year, so then we can do the correct current year calculation. So it's very important that you're not only doing the due diligence on your calculated ending assets, comparing that to your actual, so you can roll over your basis, but you need to make sure you're choosing the right accounting method. And you don't want to fall into this trap of choosing HIFO because it's going to just give you the best tax outcome if you haven't been managing your assets on chain properly to be able to substantiate what you're claiming under HIFO. So if you're just, buying a bunch of fungible cryptos on exchanges and then sending them to cold wallets and commingling them all together, it's unlikely you're going to be able to apply specific identification because you're not going to be able to choose which asset that you're selling or transferring at any given time at that point of the transaction. So that's why you're going to have to default to FIFO in most cases. Now, there are isolated cases where specific ID can work, but I see most people who are just choosing HIFO as a blanket election on their portfolio are doing this under misguided advice, and it can create huge issues from a current year tax perspective, but also it causes this basis issue moving forward as well, and it can be a lot to unwind. So that's basically what we had to do here with this client, was unwind all of this so we can get an accurate basis calculation for them. And this also eventually included us in many returns for them because of the inaccurate reporting in prior years. So next up, I want to point you to our firm's website at CamusoCPA.com, to our latest blog. What you need to know about the statute of limitations on cryptocurrency taxes. So this is a question I get a lot. I think this is really important, especially considering we're still working with clients every day going back into the 2016, 2017 timeframe. So I'm not going to go over all the details of this, but this is going to go over some of the considerations around cryptocurrency audits and really focus on the statute of limitations and how that can apply in various types of scenarios. So, give this a check. I think, if this is something that you're wondering about, this article is going to do a great job of explaining it. And there's some good information in there as well, just about the audit process in general. Lastly, I would, if you're on the website reading the blog, head over to the newsletter section and sign up for our newsletter, the Digital Asset Digest. We are delivering weekly information to your inbox. Some of the things will be things that we cover on this podcast, and then there's a lot of things where I just don't have time to get to it on the podcast. We also bring on special guests and have them do pieces in the newsletter. So there's a lot of valuable information there that's going to keep you up to date above and beyond this podcast, because there's more information that I can put in that. So I would encourage you, to check this out as well. And I think that it can offer you some significant benefits in terms of keeping you up to date on the regulatory environment. So those were, most of the items that I wanted to go over today. We still are on our final push for tax season here. So I'm trying to keep these brief. And, that is one of the big purposes as to why, because, we do have a lot of clients that we're serving now. And to that point, if you are a digital asset investor or you're a Web3 business owner and you're looking to get your accounting taken care of, or you need to get someone to manage your compliance and tax needs, look no further than Camuso CPA. And if you want to speak to me directly, you can reach out to me on LinkedIn. You can go to my website at CamusoCPA.com and fill out the contact us form. And we'll find a time for us to sit down, speak together, discuss your accounting and tax needs, and design the best accounting and tax compliance system for you. So if that's something that you guys are interested in, feel free to reach out. Otherwise, I hope you got some value today out of this stream on the financial frontier. And until next time, I'm Patrick Camuso, signing off.